Self-employed and torn between a SEP IRA and a solo 401k? Pick right, you could shelter 5 figures. Pick wrong, you might leave tax savings on the table. Let's map it simply. By the end, you will know which one likely gives you the bigger deduction, which one is more flexible, and the deadlines that catch people off guard. Quick, plain English. Think of this as choosing the right backpack for your profits. Both carry money to retirement, but the pockets work differently. We will try them on. No jargon, just choices. ASEPIRA is a simple employer-only retirement plan. If you are self-employed, you are the employer, so you contribute on behalf of yourself. Like a single big shovel. A solo 401k is a 401k for a business with no employees other than you and maybe your spouse. You wear 2 hats, employee and employer. 2 pockets, same backpack. Both accounts let you reduce taxable income today, grow investments tax-deferred, and pay tax later in retirement. Some versions also allow Roth, where you pay tax now and take qualified withdrawals tax-free. Analogy time. SEP is one big scoop you take after you see profit. Solo 401k is 2 scoops you can fill during the year and after, within limits. Different grip, different reach. Administration differs too. SEP is plug and play at most brokers. Solo 401k is still easy, but has more knobs like Roth, loans, and paperwork once it grows. We will weigh that. Bottom line definition. SEP equals employer contribution only. Solo 401k equals employee deferral plus employer contribution. That split drives the math. No salary deferral exists in a SEP. Best fit for SEP. Solo owner who wants simple, has solid profit, and does not need Roth or loans. Also works if you have employees and want to give everyone the same percent. Best fit for solo 401k. Solo owner with no common law employees who wants to maximize savings on lower profit, use Roth, or allow a plan loan. Spouse can join. If you have non-spouse employees who are eligible, you cannot use a solo 401k. SEP stays fine, but you must contribute the same percent for them as for yourself. If you also have a W-2 job with a 401k, your employee deferral limit is shared across both jobs. The employer piece from your business is separate. We will show numbers. SEP contribution is usually up to 25% of W-2 wages, or about 20% of net self-employment income for sole props and partnerships, capped by an annual IRS limit. Your tax software, or IRS, Pub 560 worksheet computes the exact figure. Solo 401k lets you first do an employee deferral, up to the yearly 401k limit, then add an employer contribution similar to SEP percentages, up to an overall plan limit. Employee deferrals can be pre-tax or Roth if your plan allows. 2-hat math example. Profit is $60,000 as a sole prop. Solo 401k could allow a big employee deferral plus about 20% employer. SEP only allows the 20% style amount. Exact dollar caps change yearly, so check current limits. On the same $60,000, SEP might land near $11,000 to $12,000 depending on the self-employment tax calc. Solo 401k could push higher by adding the employee deferral on top. Exact limits change. We will keep the math rounded. Flip it. S-Corp paying you $40,000 W-2. SEP allows up to 25% of wages, about $10,000. Solo 401k could add the full employee deferral, limited by your wages, plus up to 25% employer. High profit case. With very high income, both plans may hit the same overall cap. Then the tiebreakers become Roth option, loan access, and filing requirements. For some, paperwork is a fair trade for options. Heads up for sole proprietors with no employees. Since the Secure Act 2.0, you can establish a solo 401k retroactively for last year, all the way up to your tax filing deadline. You can also make the first-year employee deferral by April 15th. S-Corps and partnerships still need to establish the plan by December 31st to make employee deferrals. The retroactive rule is only for sole proprietors, Schedule C filers in the first plan year. Paperwork. SEP IRA has almost none. Solo 401k adds a one-page Form 5500 EZ filing, once plan assets cross $250,000, or when you close the plan. Not scary, just a step. It files online and takes minutes. Mistake 1. Thinking the employee deferral limit is per plan. It is per person across all 401k, 403b, and similar plans you are in. Do not double dip. Your W-2 and your side gig share that same bucket. Mistake 2. Over-contributing because you use 25% on a sole prop. For sole props and partners, the effective rate is about 20% after the self-employment tax adjustment. Use a calculator. The funding deadline is more flexible than people think. Employer contributions for either plan can be made up to your tax filing deadline, including extensions. Employee deferrals follow stricter rules. In the first plan year for solo Schedule C filers by April 15th. Mistake 4. Hiring your first W-2 employee and keeping a solo 401k. Once a non-spouse employee becomes eligible, the solo 401k must change or close. Know the rules. Plan documents spell out who counts as eligible. Mistake 5. Forgetting Form 5500EZ when assets cross 250k. Late filings can bring penalties. File it even at 0 if you terminate the plan. Calendar it. Mark a recurring reminder every June. Mistake 6. Assuming SEP and solo 401k contributions do not affect the QBI deduction. They do reduce qualified business income if pre-tax, which can change your 199A math. Model it. Roth contributions do not reduce QBI. Pro tip: use Roth deferrals in a solo 401k to avoid reducing QBI while still saving for retirement. That can preserve a bigger 199A deduction in some income bands. Check your bracket. This is huge for service businesses near the phase-outs. Pro tip: your spouse can participate. If your spouse works in the business and is paid, a solo 401k can double the employee deferral room and add another employer contribution. Great for family shops. Pro tip: loans. A solo 401k can permit participant loans, commonly up to 50% of the balance up to a cap. SEP IRAs cannot offer plan loans. Use with caution and a payoff plan. 2026 change to know. If you are age 50 or older and had more than $150,000 in FICA wages last year, your catch-up contribution must go in as Roth. That is from final IRS regulations late 2025. Pro tip: rollover strategy. Some people roll old pre-tax IRAs into a solo 401k to clear the deck for a clean backdoor Roth. Execute carefully to avoid taxes. Custodian can help. Move first, then convert to avoid messy taxes. Pro tip: provider features vary. Some solo 401k documents allow Roth, mega backdoor, after-tax, and loans. Others do not. Read the plan or pick a provider that matches your goals. Do not assume. Ask before you sign. Pro tip: SEP can be Roth too under newer rules, but many custodians have not implemented it. If used, Roth SEP contributions are taxable now, unlike the usual pre-tax SEP. Ask your broker. Confirm how it shows on your return. Action Step 1. Decide your priority. Is it max dollars saved on modest profit, simplicity, Roth access, or loan access? Circle your top 2. That points to a plan. Write them on a sticky note. Action Step 2. Run numbers. Use a solo 401k and SEP calculator with your profit, W-2 wages if any, and current limits. Compare totals and tax impact. Screenshot the results. Save the worksheet for tax time. Action Step 3. Check timing. If you want a solo 401k this year, set it up before 12/31. If you favor SEP, you can wait until filing time, but earlier is better. Providers get swamped in December. Action Step 4. Put compliance on your calendar. Year-end setup for solo 401k, funding deadlines, and a future note to file Form 5500EZ if you cross 250k or close the plan. Simple habit, big savings. Want more plain English tax wins? Subscribe. Next, we will break down equipment versus supplies. Section 179 explained, so you know what to expense now, and pair it with home office deduction explained to stack savings.